Hello, everyone. Hopefully, everyone's doing well. Well, today we're going to talk about NuVista Energy. We're going to understand what NuVista is all about. But before we do that, here's my disclosure here. For anyone, not investment advice, information only. Maybe entertainment, I guess, for some. But yeah. Hopefully you like that. Hopefully you like this presentation. So what we're gonna do today, we're gonna talk about corporate slides for NuVista, and we're gonna look at their basically Q1 finances, better understand what's going on there. It's a name that's been liked by some on social media, on TV, so I'm gonna kind of carefully review the name. All right, so this is corporate presentation. It's in the public domain, so available for all to take a look, to view. There's my ruler. All right, so let's kind of start. NuVista Energy. There is some disclosure here, so please pause and take a look. Okay, I'm gonna maybe minimize myself a little bit here. All right, right there. So NuVista Energy is one of the largest independent condensate-rich Alberta Montney pure plays. You may recall, and I'm gonna get back to the slide right away, that for Vermilion Energy, we talked about in the previous presentation, we talked about kind of the different regions in the Montney acreage, and we talked about gas partitioning, or lake phase, and all that. Well, NuVista, it's a very kind of concentrated area, but they are a little bit more on the also oil side. So they're not just purely like wet, dry gas. They're not purely dry gas, but they do have wet gas and some oleic phase, I guess, which is what we talked about, hexane, pentane type of mixture. And that's really called condensate, right? So condensate will be condensate rich Alberta Montney pure play. So as they allude to here, it's and you can see on the map in this kind of green Montney area there. They're on the Alberta side mainly, and that's it. NuVista Montney, right? So they're approaching about 90,000 barrels a day. They call BOE per day. So BOE stands for barrel of oil equivalent. So not necessarily BBLs, but BOE. So where they integrate kind of the gaseous phase into the overall production, usually measured in MCF, right? So you translate to BOEs per day. And yeah, so that's current production, close to 90,000. We're going to see what it's like in Q1. 40% total liquids, which is incredible, right? So if companies like, say, like Birchcliff, they'll produce, I think, north of 60,000 barrels a day, maybe closer to 70,000. But then they'll produce mainly dry gas, where here you have 40% total liquids. So 3/4 of which is high value condensate. So the pentane, hexane type of molecule, C5, C6. And 480 million of shares repurchased since 2022. And we're going to kind of look a little bit further into that. And you can see they have basically in that NuVista Montney region, they have, if I go from north all the way down to south, they have North Pipestone asset, South Pipestone, Gold Creek, which is well known in the Montney, Elmworth as well, and Bilbo. So those are the main regions. And on the left side here, you can see that they're suggesting they have established track record, prolific depth and scale of repeatable high-value inventory, and runway set for material growth and shareholder returns. And, we've heard in the past that this company plans on growing. I think it was close to 30% or something like that, and then returning free cash flow to investors once they're done. So commitment to returns, right now 75% of the FAFF to share buybacks, It trades at TSX NVA. And again, you saw the disclosure, another recommendation. Market cap at $12. I think it's a little bit less now, but at $12 is 2.4 billion, and Q2 2025 guidance is between 75,000 to 77,000 barrels a day, BOEs per day, and 2025 production guidance in BOEs per day is 90,000. So that's kind of the growth I was alluding to. And 2025 capital expenditure guidance is about $450 million, as you can see. All right. So when it comes to production growth, as we mentioned before, 2025 exit kind of heads towards 100,000 BOEs per day. So that's very significant. And since 2020, that's basically doubling of the production oil rate, gas rate, right, in BOEs per day. Net reduction of debt, they talk about that. In 2020, the debt level was 600 million, and now it's about 230. So if we go back and trying to come up with the enterprise value for this company, it's about $2.63 billion, right? So if you add 2.4 plus the debt of 230 million, you get 2.6 to 2.6 or so. And it depends what share price as well, right? If it's $12 and you trade at basically 2.4 billion, then you add the 230 in debt and you get basically net debt reduction of 370 million in net debt since 2020. So basically significant growth towards 100,000 BOEs per day, and pretty reasonable enterprise value here, where the debt to enterprise value ratio, net debt to enterprise value ratio is less than 10%, which is great. And they talk about shareholder returns here, 480 million total returns to date. And let's keep going. So what you see here, basically, they talk about all right, so they talk about, maybe I'll remove this live display. So 2025 budget, low risk growth, resilient returns, well outperformance, strong execution, enhanced shareholder returns, 7% annual production growth, 15% per share, including anticipated share buybacks, 200 plus million free adjusted funds flow annually. And if you take the enterprise value, 2.6 or so, 2.63, something like that, and 200 divided by that, that's already just under 10% free adjusted funds flow. If you divide by enterprise value, just less than 10%, and then capital allocation towards growth to exceed 90,000 BOEs per day, and return of capital minimum $100 million. First 100 million back to shareholders plus 75 of remaining free adjusted funds flow. So FAFF, free adjusted funds flow. So here we have inherent flexibility, 225 capital reduced by 20%, ability to adjust capital program to maximize returns while achieving a return of capital target in a lower commodity price environment, layering on additional growth, and return of capital in a high commodity price environment. And again, I talked about this in the past in my previous videos about the concept of condensates and mixing condensates with or diluent with bitumen so you can flow. And currently, this is kind of the most economic way of shipping bitumen on large scale, by mixing in a pipeline with lighter hydrocarbon, which is what basically some of the products that NuVista is producing. So what we see here, production outlook, 2025 budget annual production outlook, corporate production. So we can see significant growth basically from going from 77,000 BOEs per day in kind of Q2 2025. They reported close to 90,000 barrels a day, BOEs per day in Q1. And they're heading towards Q3 significant growth, kind of over achieving the numbers reported in Q1 and getting to Q4 2025 at 100,000 BOEs per day. So current annual production guidance is 90,000 BOEs per day. So Q2 may come kind of short of maybe some people's expectations, but the guidance here is very clear that production is going to be a little bit lower, and then you get that boost in production towards year end. So this is something for sure to look for as incremental free adjusted funds flow AFF is increasing kind of towards the year end. So there's a kind of embedded torque in that. Current annual production guidance 90,000 BOEs per day. Late Q2 anticipated third-party Pipestone plant startup. It adds 8 to 10,000 BOEs per day production capacity, and plant gas plant turnaround 6 weeks in June, July, impacting Wapiti, Pipestone South, which kind of explains, I guess, the Q2 numbers, right? So Q1 will be January, February, March. Q2 will be April, May, June. And so clearly June impacting the Wapiti, Pipestone South, 6 weeks turnaround. And 100,000 BOEs per day milestone by year end, and ability to offset capacity interruptions into Q4, deliver on guidance. So this is kind of what to expect for when it comes to their basically delivery for the year. And you can see how the adjusted funds flow here, the column on the scale, in millions, right? So 400 million, 600 million, 800 million on the Y scale. And you can see the sustaining capex is about just north of 300 million. And then you get minimum shareholder return target, which is kind of the midsection, the green light column there, and kind of gets you towards that 500 million mark. And growth capex, a little bit more, kind of about 100 million, I guess. And then the other column is the free adjusted funds flow. Additional free adjusted funds flow, I guess, coming in at $70 WTI and $4 gas. But at the same time, today we're in an environment of $61, right? So 61, 62 WTI with capital of 100 million that they share here. Essentially, if you look at the price target just under 60, you get the additional free adjusted funds flow, but maybe not in that, on that scale, just kind of the $100 million kind of adjusted funds flow. At the same time, I assume there is big commitment to growth capex and minimum shareholder return target. And so we calculated that in kind of that free cash flow yield or the free adjusted funds flow over enterprise value, which is the minimum shareholder return that you can see here. And then additional kind of stuff, they're looking at a little bit more torquey. So this name kind of works in low price environment. This is looks like a lower cost of supply type of company. And at the same time, there is kind of this embedded growth that will be generating future free cash flow in the upcoming years, especially in the higher gas and oil price environment. So one could argue that this plays maybe a little bit countercyclical, where the investment is in a price environment that is a little bit lower, kind of at least on the oil side, and you get the torque as the prices maybe increase in the upcoming years. You get the benefits of basically the current investment. And additional free adjusted funds flow allocation, 75% to shareholder returns, and ability to tune capital program and growth to commodity prices. So basically, they suggesting they want to exercise flexibility as they go forward. So this is investment thesis, material low risk growth and returns. As you can see here from 2021 timeframe, runway set for growth to 125,000 BOEs per day. So as you can see, there is some kind of ambition here to kind of keep going on the growth side, and 300% increase in production per share, 15 to 20% annual growth per share, mainly through kind of increase of the oil production rate. And we can see it from 2021, they go to 50,000 BOEs per day. 2024, sorry, they go to 75,000, and 2027 they go towards 110, and 2028 towards 125. So they do have those pillars for growth in place. inventory de-risk, egress contract signed, facilities ordered, and they have the team in place, as you can see in this slide. As we move forward, the domestic condensate hub, they have NuVista, that suggests is the third largest Alberta Montney condensate producer, which is kind of like a big statement, but good on them, right? And you can see the various kind of Grand Prairie region Montney condensate production over time as it's been kind of ramping up, and there is kind of the suggested volumes, right? So just north of 100,000 BOEs per day, but Alberta Montney condensate production by operator, you can start seeing ARC, and we know ARC is one of the kind of more advanced, I guess, condensate producers. And now it's going to be a little bit more with the acquisition of Strathcona assets, I guess. And the Grand Prairie region represents 90% of Alberta Montney condensate production in the Grand Prairie region, right? So, and now you can start seeing, like in 2025, you're a little bit north of that 100,000 BOEs per day. And obviously NuVista, plays a big role as a third largest producer. Now, I'm skeptical of the fact that maybe ARC and Ovintiv going to be divesting their condensate-rich production, and so you have like the small play, essentially 2.6 billion enterprise value, roughly, kind of competing really well, being the third largest Alberta Montney condensate producer. And the other companies is Strathcona, Whitecap, CNQ. Then you have very little from Birchcliff and Advantage. So what's really kind of interesting from that perspective is that while Whitecap just merged with Veren, CNQ, I don't think anything is for sale over there, and Strathcona just divested, right? So the amount of players kind of is smaller, and yet NuVista has this slight higher cut for condensate. 90% of Alberta Montney condensate production is in the Grand Prairie region, and condensate, as they say here rightly, is the premium product that drives 2/3 of their revenue, which is kind of huge, right? If you think about this, so there is kind of this embedded torque towards gas prices. 2/3 of the revenue comes from the condensate production, and here we can see basically the regions where the company is located. On the right, you can see North Pipestone, South Pipestone, Gold Creek, and Bilbo, and Elmworth from kind of the west side of that envelope, and the various companies that participate there, right? So you have CNQ, you have Ovintiv, ARC, Veren, Shell, Strathcona, that just divested their assets. And that's kind of really intriguing to kind of better understand. And I talked about this in the previous presentation, where it's like you have almost like pieces of puzzles, and how do you maybe some M&A in the future optionality, I guess, especially with high, with the companies like maybe ARC, or you can see Ovintiv over there, and you have kind of Veren, Whitecap, I guess, to the east. And so really interesting dynamics that take in place. And I'm not suggesting, this is something that's going to happen anytime soon, but definitely kind of provide some insights to where things are located. Well, when we think about the condensate pricing market and supply-demand fundamentals, I mean, I could personally tell you, I mean, probably the demand fundamentals are very, very strong for condensate, simply because bitumen production seems to be increasing year over year. And with TMX, there's kind of increasing need for dilution of bitumen so it can flow in pipelines. So Western Canadian demand exceeds domestic supply, right? And if that's the case, then the conversation really becomes about tariffs. Like, where do you export the condensates from, right? If you export from US, maybe there is a tariff risk here. So local products kind of have a premium pricing over long term, in a sense, so which is very encouraging. So 2025 Western Canadian demand forecast is over 800,000 barrels per day for condensate, right? And we saw in the previous slide that the production is simply not from the Grand Prairie region that represents 90% of Alberta Montney condensate production. is not really catching up with that demand of over 800,000. So a lot of those barrels have to be kind of imported, shipped back, so bitumen can be diluted. And as the product moves from, as you can see on this map, from Fort McMurray towards the Chicago PADD 2 region, 2025 domestic production forecasts of 570,000 barrels per day, import capacity on Cochin and Sovereign Lights up to 280,000 barrels per day. So that suggests very healthy kind of demand going forward. And Western Canadian condensate supply and demand, you can see on the chart where and how it's being shipped. So domestic production, right? Domestic production is about 600,000, 625,000 barrels per day. Total demand is, as I suggested, over 800,000 barrels per day by 2028. And you have significant imports. So Canada is kind of short of this product, right? So you have rail imports, Sovereign Lights imports, Cochin imports. So all of them are all of those are imports, right? And so where do you go from here? This is a premium product that gives a lot of value. Okay, so let's talk about now about the NuVista assets and thick Montney package with multiple proven zones and several emerging zones from the three development regions, right? So North Pipestone, South Pipestone, Gold Creek, Bilbo, that have two-layer development with 3 layers in testing, and Elmore, of course. And so what you can see here in this picture that you have proven 3 to 4 layer development, and those will be in the North Pipestone, South Pipestone. And the 2-layer development with testing, the 3 layers are in Bilbo, Gold Creek, and Elmore. And those are the proven 2-layer with 3-layer potential with the prospective target intervals, right? And so what this really means is that you can kind of land horizontally in those, on the vertical, and you go horizontal, and then you frog those formations. Those will be basically kind of in different elevations at so what it says here, 200-meter total thickness interval. So 200 meters, that's significant, right? You can kind of pick and choose your location, I guess. And then for assets like Elmworth, you can go a little bit deeper. In Bilbo, you can go a little bit deeper. But you do have kind of 2 proven 3 to 4 layer developments in North Pipestone and South Pipestone regions. What we see here, multi-decade inventory base, booked money drilling inventory. So we can see total locations about over 1,500, right? And the high quality inventory sustains 25 years of economic development. So there is no need really to kind of do M&As from their side, but I assume there will be need maybe from somebody to kind of make a push in the future and maybe do M&A with them, but the company itself doesn't really have to do anything at this point, right? And so you can see the development to date regions on the map in green, and development to year end 2028 is in blue on the right side, and the light blue is development to year end 2033. So you can see some west regions in Bilbo will be targeted to next decade. But in Gold Creek, for example, you have development that's currently happening right now, kind of short-term development and long-term development plans. Same goes in kind of this North Pipestone region and as well as South Pipestone. So inventory overview, NuVista Montney continues to outperform, consistent track record of reserves, growth and value creation. So you can see basically this increases over time. 3-year reserve replacement, PDP. So just a reminder, PDP stands for proved, developed, produced, right? So proved, developed, producing. And TP plus PA, you can see in this graph, 350% stands for total proved plus probable reserves. So 3-year reserve replacement of 350%. And you can see the NPV per share, right? So for those that don't know, obviously, if you kind of look at the context of the value proposition, NPV per share is net present value per share, right? So the PDP and proved developed producing reserves, and the TPPA, total proved plus probable reserves. And so they're basically saying we're good when it comes to reserves, and it's only kind of increasing over time. Sorry, maybe it's a little bit kind of confusing, all the kind of language here, but I want to make sure it's kind of clear to people that may be reading it for the first time and just not sure what those acronyms are. Emergence of prolific resource. The lower Montney has evolved into material, consistent, and highly economic portion of the NuVista portfolio. You can see here the map and the production growth at 50% liquids, kind of towards the 2024 timeframe, and inventory expansion plus high grading. So how is their portfolio here? What they're saying stacks up against others. So they basically say payout rank top decile, right? And so you can see basically they rank pretty well in the overall kind of half cycle payout periods, right? So those are less than a year, right? So if I'm not mistaken, those are even close to maybe 0.7. So maybe like 8-9 months payouts. And we saw some of those numbers with the Vermilion in my previous presentation. And you can see basically they compare themselves to Cardium plays, Montney, other Montney plays, K-Bob, Duvernay plays, and it seems like the Clearwater region's very economic, right? So the payouts there are very quick, and that's really you basically drill a well, and this oil is mobile and kind of flows into the recovery, and it kind of has doesn't need to be heat transferred, right? It's just kind of mobile oil in situ. So there's this opportunity. Canadian E&Ps, PDP recycle ratio versus annual average production growth per share. You can see 3-year PDP recycle on the x-axis and 2026 3-year production per share on the y-axis, and they basically saying they rank pretty well, and they compare themselves with companies like Headwater and Cardinal, Surge, Tamarack Valley, Varen, Whitecup, right? So median of 9% and median on the x-axis 1.8 multiple, which is the 3-year PDP recycle ratio. So they're very proud of that, I guess. Here they talk a little bit more on the Pipestone proven top tier asset, material running room, flagship asset, 20-year low risk, high return inventory across asset base. And you can kind of see the production oil rates going from 45 in 2023 towards 62,000 barrels of BOEs per day in 2026. And Pipestone book locations, you can see kind of the developed and undeveloped areas, where in the developed, I think other 419 locations, you have 167, and undeveloped 252, suggesting more opportunity in the future. So here they provide some type curves on cumulative type curves, I guess, and cumulative condensate production. And those are kind of plateauing, as you can see, over the amount of days, and kind of ramping up production in plateau environment. And I guess what they're trying to tell us here is that over the course of time, through optimization, those cumulative condensate productions are only increasing. And same goes with gas production rates on a cumulative basis. And again, the difference between daily rates to cumulative is that you kind of aggregate the daily productions, and you get the curve that basically showcase overall production of the resource. And you basically accelerate cash flow that way, right? In a way that you have this multiple of first year capital returned getting lower over time. So the paybacks are much faster in a sense. They talk about Wapiti as well. I guess the theme here is that, hey, we developed some locations, 228 locations, but we have over 900 locations. And again, a very similar kind of value proposition, when year over year you're basically increasing the growth, 30,000 BOEs per day, 40,000 BOEs per day in 2025 out of their overall production. So that's a significant kind of producing asset for them. and you go towards 62,000 in 2028, and so a lot of the growth coming from that they propose from assets like this, right? So significant resource in place, 25 years of proven liquids rich inventory, operational and performance investment drive premium returns, 62,000 BOEs per day in 2028, and growth through infrastructure build out and debottlenecking, right? And here basically they're saying 425 million of annual FAFF, which is free adjusted funds flow at plateau. Again, they provide some type curves, how they're able to accelerate production or get cumulative condensate production, as well as the gas, I guess, is maybe not as good as 2024 for this specific asset, but you get that incremental uplift in condensate through in this asset in 2025, which is pretty good. And you can see on the map kind of the rich condensate and volatile oil areas, right? So those will have more kind of wet gas, oleic phase kind of production, and dry gas is a little bit more to the kind of southwest corner, I guess, of that area. Lower Montney delineation here. So again, they provide they showcase some value proposition in the Lower Montney portfolio of high quality wells with range fluid composition. So you can see kind of the different, the regions and how those Lower Montney average cumulative production kind of on the graph over the course of days showcased relatively to cumulative production and where the production is coming from. So obviously we can see that southeast Gold Creek is really performing for them, right? And so that's good. Let's talk a little bit about, I guess, economics here. So in this table, they show different type well parameters. So EUR, so that will be EUR will be the estimated ultimate recovery, right? So in BCF, and you can see the different basically Wapiti regions. So Wapiti Base, Wapiti Rich, Pipestone Very Rich, and estimated ultimate recovery is 8.8 BCF, 6.5, 7, 5 BCF. CGR here stands for condensate gas ratio. So you can see how the partitioning basically takes place. Usually, there will be like a gas to oil ratio or oil to gas ratio. This is kind of condensate to gas ratio. And so you can see basically the different partitioning of C5 plus BBLs over MMCF. They use that ratio just to showcase, I guess, kind of the oleic phases. DCET capital. DCET stands for drilled, completed, equipped, and tied in wells in this table. And you can see basically they showcase that they spend less capital for Wapiti Base, so going from 9 million to 8.6, and Wapiti Ridge from 9 million to 8.1. And horizontal length for all about 3 kilometers, and proppant intensity is about 2 tons per meter, I guess, and 2.5 tons per meter for pipestone, very, very kind of rich zones. So again, one of their kind of, not only the idea is not only returning that free adjusted funds flow, but also growing significantly, right? So we can see towards 2028, getting kind of towards that closer to 125,000 BOEs per day. And they kind of getting a little bit repetitive here on the 300% increase in production per share. And that's pretty significant, right? Free adjusted funds flow outlook. So they showcase basically the different levels, and I guess that will fluctuate based on certain assumptions, right? So where oil is at, WTI, where AECO would be, which is basically the physical storage and trading hub for natural gas in Alberta. And based on those assumptions, they basically provide the annual free adjusted funds flow and give us a little bit sensitivity. So if the annual free adjusted funds flow at $65 WTI and $3 gas, then you get the kind of green column. And if you have annual free adjusted funds flow at $80, you get that additional torque, where by 2025 you get over 300 million, and by 2028 you able to get over 450 million. And what they're saying here is that basically up to 2.6 billion free adjusted funds flow from 2021 to 2028 being generated with the growth plan resilient to price environment volatility. So there's kind of good sensitivity that they provide here, that they did some due diligence here. So minimum 75% of free adjusted funds flow to share buyback. So I guess this name really is maybe not a dividend play, but it's a name that's kind of growing production and buying back shares. And that's where the value proposition comes in the form of basically per flowing per share, or a return per share on kind of with the adjustment on the oil production increase, maximizing long-term shareholder through growth and returns. So the messaging is pretty significant, consistent, sorry. So significant reduction in net debt. So you can see from 2020 to 2021, I think they have a typo there. So it says Q2 20. Oh, I guess it's okay. 2022, 2023 slowed down a little bit there. I guess the net debt increased a little bit from the time frame, but there was significant reduction, I guess, in net debt, going from Q2 2020 over $600 million net debt towards under 200, right? And so with that ambitious growth plans and basically ability to generate the free adjusted funds flow, something that I give. But I would say if your enterprise value is like 2.4, 2.3 billion, and your net debt is 200 million, that's okay. Like that's not bad, right? I mean, there shouldn't be a penalty for a portfolio that looks like this, or a balance sheet that looks like this. I think it's pretty healthy. So comfortably below net debt to AFF target. AFF stands for adjusted funds flow, and of in stress test environment, I guess. 165 million senior debt termed out to 2026 at 7.78% coupon. Additional credit facility 580 million, just provide some flexibility there. And material available liquidity, credit capacity. You can see senior term notes, right, going kind of towards 750, and credit utilized just around 200 or so. So when it comes to kind of asset diversification, natural gas volume exposure by market, so that's kind of important from a perspective of where basically the product goes to, right? So where does it end up? And what we can see here is that some of the production, I guess it's hedged. Then you get NYMEX, right? So NYMEX production. NYMEX, as many of you know, stands for New York Mercantile Exchange. Then the other market they're exposed to here in kind of lighter blue is Chicago. Then you have California, Dawn, right? So Dawn is a very kind of important hub, I guess. Emerson, Ventura, AECO, that stands for Physical Storage and Trading Hub for Natural Gas in Alberta, and LNG, liquefied natural gas. So marketing program broadens exposure to mitigate local market risks. We've seen a lot of activity in Tourmaline, right? The way they've diversified their kind of marketing portfolio. They taken first step into world of LNG markets, which is kind of exciting. You can see 2027, 2028 timeframes. And has taken only 10% of gas production exposed to AECO. And AECO, it's challenging, right? Like the price environment could be challenging at times. And so they're saying, look, only 10% AECO. And 36% of gas production hedged at AECO equivalent of 3.7 Canadian per MMBTU, floor by 425 MMBTU ceiling. So in that kind of range. So I guess this is more, I guess, promotional slide, but I think we covered a lot of those. Focus kind of growth, Montney pure play, established track record, prolific depth, scale of inventory, runaway set for growth in 2125 BOEs per day, and growth amplifies value and return. And again, we talked about per share value that's being generated. And kind of that's it. But that's what they have here. And I think one of the more favorite slides that 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 they have from them basically describes holistically what the company kind of does would be this slide where you see an NuVista Montney play, but this is mainly kind of on the Alberta side, right? So which is kind of a cool learning. I wasn't really sure exactly if they're a little bit on the BC side, but seems like it's kind of mainly in Alberta and approaching 90,000 BOEs per day. But we saw like over time, like the Q2 is going to be 77, 78, but then it kind of increases kind of towards 90,000 BOEs per day, which is the target for production guidance for 2025. So yeah, Q2 expects 75 to 77. And I really like, what I really like personally here is that not too much debt. There is this growth, but I like the fact that there are some condensates here, especially in tariff environment, right? With the way we import so much condensate from US, domestic condensate is becoming, I think, increasingly more valuable. So as we as we look a little bit further into kind of what they've been up to, um, I will stop the screen here and maybe share. Yeah, I'll share at this point. Sorry. I want to share their MDA from March, basically 31st. Well, ends in March 31st. Basically, their Q1 numbers. So you can see here their Q1 numbers. And we're going to be talking about them a little bit more. So let's see what the reporting looked like for Q1 and put it in kind of context of future production, I guess. So from daily production perspective, we can see here that the total BOEs per day in Q1 it was already closer to 90,000 BOEs per day, right? So the guidance is 90,000 BOEs per day, and they already kind of achieved that in Q1. It's going to be a little bit less, like we said, 75, 77 or so in Q2. But here you start seeing the BBLs in the condensate, so 25,000. Natural gas, 334 mmcf per day. You get some NGLs here, right? So 8542, and total BOEs is 89,000. Condensate NGL weighting, 38%. Condensate weighting, not 28%. So that would be very healthy, right? So close to 30%. And if we compare to 2024, it was 30%. It was 39% for kind of the combined condensate NGL weighting. So revenues are higher in 2025, and that makes sense because production is growing. Adjusted funds flow, 191 versus 135 in 2024. And again, we're comparing the 3 months Q1 timeframe. So it seems like the numbers are doing quite well. Now, the question is what's happening to debt levels. So debt would be here. So 267 million in Q1 and 261 in Q1 2024. So debt levels are up a little bit by $6 million, but I wouldn't say it's a big deal because debt to the enterprise value is, what is this, like, I guess in this case will be 11, 12%. So that's okay. That's very logical to me. So you can see the condensate dollars per barrel, $98. So that's a premium product. And when it comes to dollars BOE netbacks, you get about 46 here. And the corporate netback, operating netbacks expect about $28, which is much higher than 21 for 2024. And what are some of the costs? I guess will be royalties, right? So net operating expenses here, transportation expenses, 475. Net operating expenses will be 1124. And so let's compare it to last year. So they're a little bit lower on the royalty side. Similar, I guess, slightly higher on the transportation side. And operating expense in Q1 is a little bit lower than last year. So corporate netbacks at 2384. All right, so that's kind of a quick overview, and let's see kind of the adjusted funds flow, or I guess what they're saying. Quarterly corporate netback Q1 2025. They're saying is a little bit higher, so I think it was closer to $30. Production, as we said, the partitioning 3828, so currently 89,500 BOEs per day, going to be lower in Q2. There's a turnaround that's going on. Average daily production, I mean, you can see kind of the growth from 71 in Q2 2023 going to 89. We're going to go a little bit under in Q2 and then back ramping up back towards Q4. And condensate, Edmonton 2025, 3 months average C5 WTI differential is 150, so very close to WTI. And in Canadian dollars, it was $100, right? Condensate at Edmonton. So here we can see basically their partitioning, right? So natural gas, condensate, NGLs. So there is a good kind of combination of, I guess, hydrocarbon soup mixtures and 3 months revenue by product. So obviously, you produce, well, that's not that obvious, but they told us that, right? That although they produce only 28% of their portfolio is condensate, it's majority of their basically revenue product by type at 60%. And you saw that basically there is no reduced demand for condensate. All right, so there's a little bit more here about kind of locations and different price environments and all that. So so maybe I'm gonna quickly search for their free adjusted funds flow, net debt to adjusted funds flow. So adjusted funds flow, you can see here, 750 million, and net debt is slightly increasing through the growth, right? But we kind of knew about that. And net debt to adjusted funds flow is in green, that kind of is plateauing. So one has to kind of take a broader view, I guess, of the fact that, yeah, the debt may be increasing a little bit, but production is also increasing. And those netbacks kind of going forward will be increasing as well. So let's talk about free adjusted funds flow and really understand here what's going on. Free adjusted funds flow, those are adjusted funds minus the net capital expenditures, right? So here we have a table of those for the 3 months in 2025. So those will be closer to 35 million, right? So 35 million. Now, if you take that number, and again, I think it's kind of a little bit weird because the production is going to decline, then it's going to increase, but we're still going to be around 90 million, I guess, 90,000 BOEs per day, close to that as corporate guidance. So I think it could be fair to use Q1 as kind of representative quarter for the year. So if you take 35 times 4, you get about 140 million. So 140 million divided by enterprise value of, let's say, 2.35 billion, the free cash flow, free adjusted funds flow yield is about 6%, so 5.95. But it's a little bit unfair to use just that number as the free cash flow in a sense, because there's significant growth that's taking place. So when you do this calculation, you have to kind of account for that. So I would actually kind of double that free adjusted funds flow for future kind of generating free cash flow today, in a sense, to close the gap between how the capital is being allocated. Because remember, investing, that's all about kind of that, right? You take money today and you invest it, and you generate higher free cash flow in the future. So I think it's very reasonable to consider that within the free adjusted funds flow calculation. Now Q2, the oil prices obviously declined, so that number is going to decline. But I think they did a good job sharing with us about their kind of growth plans and where they're going to go from here when it comes to their production growth, and how they're going to basically exit at close to 100,000 BOEs per day, and basically have this debt that increased since that 230 million to 267 or so, to 65 on the enterprise value, and I guess the per flowing metric that becomes somewhat reasonable. So hopefully you enjoyed my NuVista um, overview of kind of the assets, their play. I think, personally for me, it was a big learning experience, trying to better understand the kind of Alberta Montney region and the kind of the diluent condensate with some partitioning, 60% of, I would say, yeah, about that, of kind of gaseous phase, and what the economics look like. So I'm fairly impressed. Again, not the financial advice. This is my disclosure. And thank you so much, everyone. All the best.